Hello everyone and welcome to the March 2024 taxable account video. Sorry for the delay on this. I recently had carpal tunnel surgery and have been recovering from that among a couple other things with work. So I am going to get caught up on this series. I'm changing the way that I do things a little bit in order to make these videos a little bit quicker, but also because I do want to start making some content as requested in the comments section about how I choose stocks and kind of the things that I'm looking for and so forth. So when I write my articles on seeking alpha, that's something that I do discuss, so I will have no problem kind of showing the behind the scenes of what that looks like. But bear with me as I try this new approach. My goal is to give nearly as much information as I previously was giving. It's just going to reduce how much work I have to put into each of these videos with cutting and pasting pictures and things like that. So without further ado, let's get started. So, as always, I'm not a financial advisor and I don't claim to be one. I do hold a number of positions in common with John and Jane, and I have that listed on the screen. And then it's a real portfolio with real shares being traded. It is not a practice portfolio or play money for those who are familiar with systems where you can go in and make fake trades. So anyway, that's why I try to include as many screenshots and information as possible to demonstrate that this is in fact real. Why I do this, John and Jane, in my opinion, were being taken advantage of by their financial advisor, and they, basically brought up the idea to me of managing their own money, and I just asked them, in exchange for doing this for free, all I asked is the ability to write about it, make these videos, and kind of share this information to hopefully empower other people who maybe don't have someone like me in their lives, so that maybe they can use this to take more control of their finances and do things that they believe are in their best interest. So with their background, John retired in 2018, collects Social Security, and then currently draws $1,106.17 a month from his traditional IRA. Jane retired at the beginning of 2021 and also began collecting Social Security then. She's not currently making any withdrawals from her retirement accounts yet. John and Jane have been drawing funds from their taxable account since January of 2022, starting at $1,000 a month, but have since increased that amount to $1,700 a month and maintain that in 2023 and moving in 2024, keeping that number the same. The other thing too is that John and Jane have investments outside of what I help them with. These are going to be particularly like low risk bonds, CDs, things of that nature. And then also, John and Jane do not have any debt or monthly payments, so I think it's a really important characteristic to consider, is that really John and Jane, the reason why they can live as frugally as they do is that they don't have, car loan payments, house payments, credit card bills, anything like that, that creates an increased demand on their cash flow. So they're basically able to maximize their retirement, live the way that they want because they have set themselves up for a very comfortable retirement. So in their account, there was 2 dividend increases in the taxable account. We had Old Republic International at an 8.2% increase, which was very solid. And then Simon Property Group, their typical nickel per quarter increase. When they do an increase, they typically increase it by a nickel. So that was, excuse me. And so that was done in the quarter for the month of, or not the quarter, in the month of March. Now, as far as trades go, this was a pretty busy month. One of the, I should say, 2 of the big things on here is going to be that this sell for RPM was the closeout of this position altogether. So RPM reached a level where it's never been a core holding in the portfolio, but it reached a level that to me, the price just, in my opinion, just doesn't justify. So because we didn't see any additional upside, it's not a core position, then that was one of the reasons why we chose to eliminate it from the portfolio. Now, in addition to that, you'll notice on that same day, made the trade for McCormick. Now, McCormick is some company that I do believe, at least at this point in time, was pretty attractive. It had been beaten down pretty considerably, and it was at an attractive buying point, and that has played out quite well considering that the share price is in the mid $70 share range. So essentially, we're for the lack of a better term, swapping these positions, getting rid of RPM, but then adding McCormick to the portfolio. And then we've been adding air product and chemicals. That one, typically we're looking for between about, $230, $240 a share when we're adding to it. And that's been playing out well for us. And then we did sell shares in EPD and Hormel. These were to close out the high cost positions. And I'll show that on the realized gain screen. You'll kind of get a better idea of what that looks like. So these are still two positions, especially EPD. We hold a significant number of shares in EPD, but in Hormel, it's a modest sized position. But this was not anything other than reducing that high cost share basis, because we were already holding more shares than we typically would have. So for March on the realized gains piece here, you can see that again with Hormel, came into a small loss here. So basically we were just trimming back those high cost shares. And then also with EPD, you can see it's a very small loss here, especially for having sold 100 shares. So this was very close, and yeah, not much more, I guess, really needs to be said about that. And then with RPM, you can see here that it was a pretty sizable gain that was taken away on this. So the good news is that this strategy of eliminating higher cost positions, and then also selling off RPM here, we're able to cancel out some of these losses here. The downside associated with this is going to be that because this is a taxable portfolio, this does open up John and Jane to additional taxable liability here. So that's something that we need to be really conscientious of, and I would definitely recommend being very conscientious of yourself if you have a taxable portfolio and you're making lots of trades in it. Really be paying attention to what your realized gains are, because you can inadvertently, even if you're making a good investment switch, you can inadvertently create a taxable situation for yourself that you're not prepared to be able to either A, pay for, or B, could force you to potentially have to sell from this new investment that you got at a loss in order to cover the taxable liability associated with something. So anyway, just really be careful about that when you're working within a taxable portfolio. And this is just for the month of March. If we go to the next screen, this is going to look at the year-to-date gain loss. And you'll notice that the only one added here is going to be Verizon, and that one was at a small loss as well. So in this case, the portfolio is up $826 dollars for the year in terms of increased taxable liability for John and Jane. Not something that we're gonna sweat bullets over, but it does create an incentive towards the end of the year to be able to sell some of the losers that we have. And not even necessarily at the end of the year, but even up until the end of the year, selling some of the losers we have to reduce this taxable liability here, so that it isn't going to hit John and Jane when the time comes for them to pay the tax bill. So this is accurate up through May 9th. This is a little bit longer time frame than we would normally have. Again, sorry for the delay in these videos, but that is the case there. So the other piece is going to be that, let's see here. I'm going to hop over to the tables here. So in these tables, instead of creating a PowerPoint, what I'm going to do is I'm going to go through here and just point out a couple things in these tables, because this is the same information that I normally copy, images of and put into a PowerPoint. But the income was down year over year for the month of March. Part of it's timing. You have Archer Daniels Midland that didn't pay out this March, but it paid out in March of 2023. We have the reduction in the size of Arbor Realty, and so that shows there, and that ends up covering the majority of the difference that you see between these. We do have a number of dividend increases when you look at these over here, where positions that haven't been added to but had increases since the prior year. The only other one that stands out to me is that we did reduce the size of our exposure to Simon Property Group between now and last year of the same time. So that's the reason why you see that dividend amount lower. But other than that, that's really the main explanation or main reason why you see such a big difference in 2024 versus 2023. Something that was really great for the portfolio was that this 571,000 ends up actually being the highest value that this account has ever had in terms of the month-end balance recorded number. So if we're looking at the averages so far here for the first 3 months of the year compared to last year, what makes this number even more impressive is the fact that they are drawing out $1,700 every single month out of this portfolio from the cash flow that comes from it. So being that they're drawing out $1,700 a month and the balance is higher here, that just tells us that the portfolio is performing well and trending in a direction that we like to see. So as far as the 7-year taxable portfolio income, you can see that this negative 5.5%, this is the conservative number. It does not include CD and money market income because we basically don't want to estimate what those are going to be because we simply don't know. It's not as consistent as, say, a dividend, where unless they cut the dividend, you know that payout is going to happen and that they might even increase it. But in this case, they might decrease interest rates, they might increase interest rates. There's just too much uncertainty with it. So that's why we have a very conservative model. And then we have the more realistic model of what we kind of expect moving forward. And I'll show that further down the line here. As far as the cash balances go, you can see that this dropped, but if you add back in the $15,000 that was recently added into the CD, that ends up bringing the cash balances up quite a bit higher. We don't count certificates of deposit in the cash balances, but that's one reason why you see it sitting at a lower point. And then for the unrealized gain loss, as you can see here, that's the highest number that it's ever been as far as I can tell. I don't think it's actually, well, closest it's been to that is basically going to be March of 2022. Otherwise, we've never had an unrealized gain loss that is sitting this high. Again, just further proof that the portfolio is doing what we would like to see it do. And then here, this just goes over the withdrawals, how much was taken out. So in total, as of the end of March, that is $37,500 that's been removed from the portfolio. So when you look at the balance of $571,000 that I previously showed you, if you added back in that $37,500, that would hypothetically end up being the account balance had we not drawn those funds out and done anything with them and literally just let it sit in the account. So I think that's important because, again, it just underscores that the portfolio is performing really well. But if we were to actually add back in the money that's been taken out, it would be performing even better. Again, just further evidence that the portfolio is doing what we want it to do. So now we get to probably what's the most important table of this. In this case, it is going to be looking at the income estimates, but it's going to be actually estimating what about when we add in CD income, if it's been averaged out, and then looking at, okay, what does a 3% increase in dividend, 5% and 7% look like? And so in this case, what you can see is that for the month of January, the income year over year was up 22.2%. So that's this number divided by this number. Okay. So in this case, this column right here for AX, this represents the dividend income, not including income from money markets and certificates of deposit. And then this column here for AY, this one represents certificates of deposit and money markets like Charles Schwab. So we got 22.2, 15.52, and then this month we had a negative 9.81%. So obviously down compared to the previous year. But even when we factor that in, this number down here, the 2.1%, is saying that assuming that all of this information remains the same, and again, to I guess some degree you can say, okay, well, CD income might be down, CD income might be up, and that counterbalances with the income that's received from the dividends. But if all these numbers were to come in what they are currently estimated to be, income would be up 2.1% year over year by the time we get to December 31st. So definitely not what we would call a fast growing year, but also this number, because we have updated April's numbers, and I'll be making the video for that here in the next couple of days. But this number was 2.9% as of the end of April. So we did see a significant jump in the income that comes in April. Again, we'll cover in that video. But just know that really we're still estimating somewhere between 3 and 5%. That's what we're kind of estimating at the beginning of the year. And really, I think a big portion of whatever increases we see after this are going to be dependent on the amount of funds that are going towards Charles Schwab money market and certificates of deposit, and then any sizable dividend increases that come after that. So the other piece too is that in the taxable portfolio, in the gain loss section here, this is going to be an update. I believe this is from 5/7. I apologize, normally I have a date with it. But it's going to be recently within the last week that I updated all these numbers. And so you guys can see here that kind of my methodology behind it. I track it. Orange ends up representing a company that raised its dividend and paid out during that month. And then I kind of hide the tabs in between that, for months that are not applicable to the month that we're looking at. But then also I do have to keep track of anything that we sold out and the dividends that have been earned from that, of which I just noticed that, well, we haven't earned anything from RPM in 2024. So that's part of the reason why you don't see anything there. But this is the total estimated dividends that we're looking at. But the portfolio, if we were excluding the things that have been received but no longer actively a part of the portfolio, we're looking at an average of about 5.5% as a yield on cost, and that's going to end up being actually, I apologize, that includes this number down here. Yeah, so that does include this number here. I apologize. And then divided by the cost basis. So in this case, it's yielding 5.5% on the funds that are in there, and that's a pretty darn good number in our book. So anyway, let me know what you guys think about the new format. Should cut the video times in half from the look of it. And let me know if there's any other things that I can address. Again, thank you for the comments. I will be responding to those, and again, making a few videos here in the near future as I get caught up with these. Thanks everyone. Appreciate it. Have a great night.